Hi, here we're going to look at account receivables management. Typically speaking, how you're going to manage your accounts receivables. Okay, the main objective of this is to ensure that you collect your account receivables as fast as possible, and at the same time, you ensure that any strict measures to collect the account receivable does not affect your sales. Okay, that will be the main objective of any account receivable management process. Okay, to achieve this there are three important things to consider. Okay, first important thing is selecting the correct customer to whom you can give credit to. Okay, to select the customers, a company can have different criteria. Okay, it may look at the past history of the customer. If it's a new customer, they can look at the ability of the customer to pay back, or they can also look at do they have enough assets to have as collateral if they are unable to pay using their regular business operations. And sometimes they may also look at the general market condition to arrive at whether a company should give credit or not. Okay, so that is the first and important thing to consider. The second important thing to consider is what are the terms of credit that a company is offering to its customer. Okay, generally the terms of credit will include the number of days within which a customer has to pay up his accounts receivables. Okay, sometimes the companies can also give cash discount as well. Okay, in generally the terms of the credit are represented like this. Okay, 2 by 10 or 2 by 10 net 30. This means that the company is giving 2% discount on the total sales value if the customer repays within 10 days of purchase. Okay, or else the customer has 30 days to repay the account receivable. If he pays within 10 days, he can claim the 2% discount, or else he has to pay within 30 days. Okay, net 45 means that there is no cash discount is given. Whatever purchase has been made by the customer, he has to repay or he has to pay up the account receivable within 45 days. Okay, so the terms of credit that a company offers to the customer will also play a role in determining how fast the company can collect its accounts receivable. Okay, third thing is the company after giving out credit should also monitor the customers as to whether they are repaying or whether paying the credit as agreed upon the terms. Okay, if they say if they are supposed to pay in 30 days, are they paying within 30 days or are they extending the credit period or not? Okay, these are the important things that you have to consider to come up with a proper account receivable management process. Okay, when you consider the credit standards, okay, there are certain effects if you change the credit terms that you are generally offering. Okay, so for example, let's consider that you are offering a credit period of 30 days now. Okay, and you are planning to extend the credit days from 30 to 45 days. Okay, if you are doing this effectively, what you are doing is you are trying to relax the credit standards. Okay, so if you do that, what is the effect of this particular relaxing of credit standards? Okay, the first impact is that the sales generally would increase because you are giving very lenient credit terms compared to other companies. Okay, so any relaxing in credit standards will help you in increasing the sales. Okay, that is the positive impact that you will have by relaxing the credit standards. Okay, but on the other side, okay, that the investment that will be held on account receivable will also increase. Okay, now instead of 30 days, you're going to give extra 15 days for the customer to pay back. So the investment which was held up in account receivable for 30 days, now it would be extended to another 15 days. Okay, so you would incur cost on that investment which is being held up in your account receivable. And also, when you give more days for the company to pay back, there is a good chance that the company might not pay it back also. Okay, so the bad debt could increase. There's a good chance that the bad debt would increase. Okay, so these two are the negative effects of relaxing credit standards. Okay, the positive effect is the sales might increase, but the negative effect is the cost of investment held up in account receivables, and also the bad debt will can go up. Okay, those are the effects of relaxing the credit standards. Okay, So to check if we can relax the credit standard, so what we have to do is we must calculate, because of the sales increase, what is the contribution to profit, or what is the additional profit that you get because of relaxing the credit standards. Okay, and then you're going to compare that with the cost that is going to increase because of the investment increase in your account receivables. Okay, as I told you, now from 30 days the amount is going to be held up for 45 days. Okay, so because of this increase in the number of days, what is the cost that you're going to incur. Okay, and third is what is the increase in your bad debts. Okay, so you're going to compare the addition to profit with the cost that you are going to incur in the investments in account receivable and the bad debts. Okay, you compare this and then you decide whether you want to go with the relaxing the credit standards. Or this question, there is a company which is selling a product at 10 per dollar, which is the selling price. The current sales level is 60,000 units and the current variable cost is $6, and the total fixed is $1,20,000. Okay, it is looking at relaxing the credit standards. Okay, so relaxing in credit standard would result in 5% increase in the sales, so which will result in 63,000 units to be sold. Okay, and the collection period from 30 days, it is going to increase to 45 days, and also the bad debts are expected to increase from 1% of the sales to 2% of the sales. Okay, given this, okay, now, and the cost of tying up funds in receivables is 15%. Okay, the investment that is being tied up in your account receivable, and the cost of that investment is 15%. Okay, now we are going to look at whether this particular company can go ahead with relaxing the credit standards or not. So to start with, you're going to look at what is the additional profit that you get from increased sales. Okay, so the sales is increasing by 3,000 units. From 60,000 it is increasing to 63,000. So the increase is 3,000. Okay, now this selling price minus variable cost will give you the contribution per unit. Okay, contribution is the additional profit that each product is going to bring in. Okay, so 3,000 into 4 will give you 12,000. So 12,000 is the additional profit that you're going to get from increased sales. Okay, the second thing you're going to calculate is what is the average investment in your account receivables, which is effectively calculating the investment that is being held up in your account receivable. Okay, to calculate that, you have this formula. You take the total variable cost of your annual sales, divide that by account receivable turnover. Okay, account receivable turnover. This is a formula to calculate the amount invested, or the average investment in your accounts receivable. Total variable cost of your annual sales divided by the account receivable turnover. Okay, so from the given question, under the present plan, first let's calculate the account receivable turnover. Okay, the account receivable turnover ratio, the formula is 365 divided by average collection period. Okay, average collection period is nothing but the average, or the receivable days. Okay, so the average collection period in this question is 30. So 365 divided by 30 will give you 12.17. So the account receivable turnover is 12.17. Okay, so the total variable cost here is 60,000 units, and under the present plan, the company is selling 60,000 units. Okay, so 60,000 into variable cost of 6, which is 3,60,000. Okay, now you have the variable cost and you also have the account receivable turnover. Okay, now let's calculate the average investment in your accounts receivable. So the average investment here is 3,60,000 divided by 12.17, which is equal to 29,581. Okay, so that is the investment that is held up in your account receivable under the present plan. Now, based on the proposed plan, let's look at what is the investment in your account receivable. Okay, here, if on the proposed plan, the average collection period from 30 will increase to 45. So the account receivable turnover is 365 divided by 45, which is equal to 8.11. So the total variable cost now would be, since the sales would increase to 63,000 into 6, which is equal to 3,78,000. Okay, so the average investment in account receivable is 3,78,000 divided by 8.11, which is equal to 46609. Okay, now these are the investments which are held up in your account receivable in your present plan and the proposed plan. Okay, but we have to calculate the cost of this investment. Okay, the cost was given as 15%. Okay, now let's look at what is the marginal investment in account receivable. Marginal investment is nothing but the increase or decrease in account receivable because of the change in plans. Okay, so you're going to consider the average investment in the proposed plan and the difference of that from the average investment in the present plan. Okay, that will be the marginal increase or decrease in the investment in your account receivable. So 46609 was your account average investment in your account receivable under the proposed plan, and 29581 was the investment in account receivable under the existing plan. So the marginal investment is 17,028. Okay, so this is the increase in investment because of the proposed plan. Okay, so the cost of this increased investment would be cost of funds 15% into that value 17,028. Okay, so the cost of marginal investment is 2554.2. Okay, so we have calculated the addition to the profit, and we have also calculated the cost of marginal investment. Next is to calculate the cost of bad debt. Okay, we calculate the bad debt under the present plan. Under the present plan, it is 1% of your sale. So 1% into selling price into number of units, so equal to 6,000 is your bad debt under the present plan. Under the proposed plan, the bad debt will increase to 2%, so 2% into 10, and the new sales of 63,000, which is 12,600. So the bad debt is going to increase by 6,600. Okay, now let's look at the net effect of this. Okay, so the addition to the profit was 12,000. The cost of marginal account receivable, or the cost of marginal investment in account receivable was 2,554, and the cost of bad debt was 6,600. So this is the benefit. This is the benefit that you're going to get, and these two are the costs that you're going to incur. So you're going to find the net effect. The net effect is 12,000 minus this value, which will give you 2,845. Okay, so the net effect or the net benefit is in positive, which means that you can go ahead and for the proposed plan of relaxing the credit standard. Let's look at another problem. Okay, in this question we are going to consider that the company is considering that they want to offer a 2% cash discount if the payment is made within 15 days. Okay, the average collection period is 60 days now. The sales is 40,000 units, selling price is $45, and the variable cost is $36. Okay, now the firm, as the question says, the firm want to introduce this 2% cash discount. Okay, the change in this credit terms will increase the sales to 42,000 units. Okay, and that 70% of these units of the sales will take the cash discount. Okay, so 70% of the customers will take the cash discount. Okay, and the average collection period will fall to 30 days. Okay, from from 60 days, the average collection period will fall to 30 days. Okay, the firm's required rate of return, or this is nothing but the cost at which it can borrow externally. Okay, this 25%. Okay, now we have to check whether to go ahead with this 2% cash discount, or not go ahead with this 2% cash discount. All right, so just like the similar question, the previous question. First, we are going to calculate the additional profit from increased sales. Okay, the sales is going to increase from 40,000 to 42,000. So 2,000 is your increase, and selling price is 45. The variable cost is 36. So the contribution is 45 minus 36. Okay, so the increase in your profit is $18,000. Okay, so because of the proposed plan, the profit would increase by $18,000. Now let's calculate the marginal investment in your account receivable. So this is a formula for you to calculate the investment in account receivable. The account receivable turnover under the present plan is 365 divided by 60, which is 6.08. And the total variable cost would be 40,000 units into the variable cost per unit, which is 14 lakhs 40,000. So the average investment in account receivable is 2,36,842.11. So this is the average investment in your account receivable under the present plan. Now let's look at what is the average investment under the proposed plan of 2% cash discount. Okay, the account receivable turnover here would be 365 divided by 30, because the collection period from 60 would reduce to 30. Okay, so the account receivable turnover is 12.17. The variable cost would be, you're going to sell 42,000 units into the variable cost per unit, which is 15,12,000 dollars. Okay, so the average investment is 15,12,000 divided by 12.17, which is equal to 1,24,239.9. So this is the average investment in your proposed plan. Okay, now if you compare the present and the proposed plan, the investment in account receivables is actually coming down. Okay, so you're going to look at what is the reduced investment in your account receivable, which is the difference between the investment in the present plan and the proposed plan, which is equal to 1,12,602.18. Okay, which effectively means that you're going to save cost here. Okay, so you're going to look at how much you're going to save. So that will be 25% is the cost of funds, okay, into the reduced investment in your account receivable. So you are saving 28,150.55. This is the value that you're going to save because of the proposed plan. Okay, now let's look at what is the effect on the what is the effect of the cash discount. Okay, because of the cash discount you're going to lose some profit. Okay, because you're going to give this cash discount and people are going to take this cash discount, which effectively means that your sales value will come down, and it is given that 70% of the people will take the cash discount. Okay, so 70 percentage into cash discount is 2% of the total sales, so 0.02 into 42,000 into selling price of 45. Okay, so this is the cash discount that you are offering, which effectively means that this is the amount of sales that you're going to forego by giving the cash discount. Okay, now let's look at the net effect of it. Okay, so the addition to profit was 18,000. Okay, and the cost in the marginal investment you are saving in the investment that is held up in AR, the savings is 28,150.55. Now the cost of cash discount is 26,460. This is the amount that you're going to forego because of the discount. So the net effect of this is that 18,000 plus 28,150 minus 26460. Okay, so the net benefit is 19,690.55. Okay, so since a net benefit is positive, you can go ahead and implement the cash discount. Thank you.